But if you have too many choices and too many options and too many elements to consider, our ability to make a good decision is reduced.
Two traders, Darren and Walter, pull back the curtain on profitable trading systems, consistent money management, and profitable psychological triggers. Welcome to the Two Traders podcast.
All right, this is part 2. If you haven't listened to part 1, then please go back and do that. This is part 2, episode 56 of the Two Traders podcast. And in this episode, we're going to talk about fishing and trading, spear fishing and trading, spearing your friend, spearing a fish, and why institutional traders, such as those traders at banks and hedge funds, have one huge headache of a problem. All this and more in today's episode.
All right, so Darren, we've got another question here from another trader. This is the third of 4, and this question is, I need to find time to trade with my work schedule. Now, this is a big one, and to me, it screams out, okay, you're probably looking at trading as sitting down, busting out a few trades, and then going to sleep or whatever, and maybe just shifting to a higher time frame is the right way to approach this. Maybe what you need to do is get to the point where you can sit down and over 15 to 30 minutes kind of just adjust your trades or have a look and make sure everything's going well, and then go on with your life and come back the next day for 15 to 30 minutes and do the same thing, instead of thinking of trading as something that you sit down and do for 4 hours or something like that. It sounds like this person's quite busy, and my gut feeling is, looking at the higher time frames, daily, weekly, 8-hour chart, something like that, that's probably going to be your answer here. But I'd be interested to hear what you have to say.
Yeah, I think so as well. And I think people have they've got an aversion to the higher time frames. I think the people who are kind of most against perhaps trading daily time frames, when they do actually switch, tend to do a lot better. Quite a few of the traders I work with have moved to daily time frame because of the time zone they're in. And it's not just about work schedule. It's about when you're trading. If you're trading on the lower time frames, you really kind of need to be there when the market is moving. So if you can't be around for the London or the New York session, then trading the lower time frames, it's going to be when price is moving and it's reacting to levels. And if you can't be around, then you're kind of putting yourself at an instant disadvantage. And that's quite easy to see if you just visually, if you look at a 60-minute chart or a 30-minute chart. You can clearly see what parts of the day when price is most active. And even if you're deciding to hold those trades for a long time, you'll see that price reaches the extremes and turns around when there's the most trading. And if you kind of step back and think about it logically, that's exactly what you'd expect it to do. So yeah, definitely it's a case of going to a higher time frame. There's no way around it really, and if you do try and find a way around it, you tend to be putting yourself at a disadvantage before you start. It might be uncomfortable moving to those slower time frames, but trading is about becoming comfortable with a lot of things that are naturally uncomfortable for you. So yeah, move up to a higher time frame. If you want more action, then just add more instruments, and at the same time keep an eye on your risk levels if you do that.
Yeah, and one of the things that I think I'm always trying to think of analogies for traders who are a bit concerned about moving to the higher time frames. The big concern is, my account's too small, so I can't have that stop loss placement on my weekly chart. Well, that's not really an excuse anymore, because there are enough brokers out there who will enable you to set your own lot sizes. You don't have to have a standard lot size or a mini lot or even a micro lot. There are brokers who will offer the opportunity for you to trade any size. So that's not really an issue. And I think, to me, is a concern, and it's just glossed over, is that trading the lower time frames is a completely different animal. And you touched on this because you mentioned that some of your traders, they do a lot better when they move to the higher time frame. So to me, that's an obvious thing. If I'm fishing, okay, what do I do when I go fishing? I'll throw a line out and I'll sit and I'll wait. And maybe a few minutes or hours from now, something's going to happen. Okay, so I don't really have to do a whole lot of thinking. I don't really have to do a whole lot of managing. I just got to hold that pole, that fishing pole. Now, if I'm a spearfisher, it's a completely different situation because I'm making these judgments and these adjustments. Sort of, I'm watching that fish, and it's, I don't know, is he going to move left or is he going to move right? I'm getting ready to spear him. And it's sort of an in-the-moment thing, and then he moves left, then he moves right, then I got to spear him. This is a really intense sort of thing that's not the same as just throwing a line out there and waiting for a nibble. This is the difference between trading the 5-minute charts and trading the daily charts. Things slow down when you trade the higher time frames, and it's a little bit more forgiving. If I'm trading the 5-minute charts, I can almost guarantee you that if it's a losing trade, it's going to hit my stop loss level. I'm probably not going to get out of the trade before it hits my stop. But if I'm trading the daily charts, there's a pretty good chance or the weekly charts, there's a pretty good chance if the trade goes pear-shaped, I'm probably going to be able to adjust it and pull out of that trade if I want to, long before my stop is hit. Now that might not seem like a really big deal, but it is when you look at the math behind that, because now it means that the amount that I'm risking per trade is actually wrong. Because if I'm averaging a stop loss or a losing trade that doesn't go all the way to my stop loss, that means if I'm saying that I'm going to risk 1% per trade in this trading system, maybe in actual, my actual trading results are that I'm only risking 0.75% per trade, because I've been able to pull out of these losing trades long before they hit my stop, because they just look really bad. Now, the whole idea of whether you're going to set and forget, put your trades in and walk away and let it hit your stop or hit your profit or get out of your trailing exit or whatever, that's a whole different discussion. But I just want to point out that there are a lot of differences, and it's in your brain, basically. The differences between trading those lower time frames and the higher time frames is a totally different thing that happens in your brain. And the only analogy I can come up with right now is the difference between spear fishing and just fishing with a line. And one of my friends told me the story where he used to spearfish, and he went out to Western Australia, where I guess the spear fishing is pretty good. And he was telling me the story where he was diving, free diving, and he had his spear gun, and he was going to get this fish, and somehow the fish had been stabbed or hit or something, and it could only swim in a circle. So this fish was swimming in a circle, and he was down there freediving with his friend, and he said he really wanted to get this big fat fish with his gun, and it kept going in a circle. It couldn't get away. It was just running a circle, and he was aiming his gun at this fish, and he's like, okay, I'm going to get it. I've got it in my sights. But as the fish was going in a circle, his friend was blurring by as well. So he's like, okay, if I shoot now, I'm going to shoot my friend. Okay, now I'm going to shoot the fish. Friend, fish. And he was like, he was in this really difficult decision whether or not to fire off the gun, because he didn't want to nail his friend. But that's kind of the thing that happens when you're trading lower time frames. You have this difficulty knowing what to do, and it's so much easier when the clock slows down for you when you're trading the higher time frames. And that's my theory behind why more traders find success trading the higher time frames. That's what I think is going on. It could be different, but if you've got a job, if you've got a busy life, like a family and a job and whatever else is going on, you've got softball on Thursday nights and all that stuff. Whatever's going on in your life, if you've got too much, the easiest way to do it is just shift your focus to the higher time frames. Check out the weeklies or the dailies or something like that. You can look at the 2-day charts. People, that you can trade the 2-day charts. You can trade a 48-hour chart if you want, or a 12-hour chart, whatever you want. This can be done. So I would definitely try and do something like that. And I think that's probably going to be your solution. So hopefully that helps.
Yeah, I think the illusion of control kind of comes in with it as well on the lower time frames. I think that if we're sort of more active in our open trades, we somehow feel like we've got more of effect on the outcome of those trades, and that, you know, generally is a bad habit, and I'd say completely untrue as well. And I see it a lot with when I'm trading the 4-hour charts, and I talk to traders about it. If you're trading the 4-hour charts, there's going to be some bars you miss because you're sleeping, and traders will want to know that, you know, what bar I'm missing and what happens if they miss a different bar. And, you know, really it doesn't make any difference, because let's say I'm awake and there's an exit for me in profit, so I can take that profit. If I was asleep, there's as much likelihood in the style that I trade that trade is going to go to more profit as it is going to retrace. So, you know, it can, the small details that we see as being really significant in general are not, but you know, we kind of have this bias that by not being there, that price is necessarily, or your trade is necessarily going to go against you. So in other words, when you miss something, there's can only be a negative outcome from that. Whereas really, you know, it can go in your favour as much as it can go against you. And I often see that I'll miss a 4-hour bar when I'm trading 4 hours, and it just won't bother me. I'll just say, okay, well, I'll just let it go another 4 hours. And you know, as often as not, it would be, you know, a good decision as a bad decision. So those small details that feel significant, they often don't. They often aren't.
So you're not suggesting that traders sleep 3 hours and 50 minutes so they can get in that next 4-hour candle?
Yeah, you know, and I think, you know, sometimes people, when I trade the 60-minute chart, you know, some days I'll start an hour later and I'll get a message, you know, why didn't you trade the 8-hour bar, the 8 a.m. bar? And it's, well, I decided to have another hour in bed. It can be significant, but the point I'm trying to make is you should question those points that you feel are really significant, because often you'll find that really they don't make a difference at all.
Yeah, that's a good point. And the other thing I wanted to dig into is this idea of the illusion of control. So can you expand a little bit on that? So you're saying that traders, because I think this is an interesting idea that a lot of people probably haven't thought of, which is, why is it that we feel like when we're trading the lower time frames that we have more of an effect on the outcome?
I think because we can make more decisions on the lower time frame, we feel like we're getting more information. I think that's probably a visual thing when we look at a candlestick chart, whereas if you were looking at a line chart, then it probably wouldn't affect you so much. So what I mean is, we'll see, say we're in a trade and we'll see a single bar close against us, say on the 15-minute chart. We, as traders, believe that we can take that information and make a decision that will affect the outcome in our favour. And that is not borne out in reality. In effect, you're more likely to make, with more information, just more bad decisions. And I think in your trading, look for ways of reducing the amount of decisions that you have to make, because in a trading environment, we're just not good at making those decisions.
Yeah, and to drive home this point, I was speaking to two traders last week. One of them at a bank, the other one at a hedge fund, and they said exactly that, what you just said, Darren, which is some of the biggest problem they have is they've got information overload. You know, these guys have so much information that comes in from their work, and they're on their Bloomberg news feed on their phones, and they've got so much going on. It's like it's really difficult for them to know. A lot of times, it's like paralysis by analysis, and they've learned over time. Both of them have learned over time to focus in on what's important, and so this is something that I know we get into when we talk about fundamental analysis. But I think you're absolutely right, and that's a really good point, which is, the information can sometimes, it doesn't help.
When restaurants design menus now, good restaurants, they look at this how people make decisions, and they find that if you put more than, I think it's 7 or 11 items on a menu, then after that people can't make a decision because they've got too many choices. And they've also found that where you place certain items on the menu will make a difference of how popular they are. So we kind of think that we're always making rational and good decisions, and that is true to a point. But if you have too many choices and too many options and too many elements to consider, our ability to make a good decision is reduced. And if that's how it is, just deciding what you're going to order for lunch or dinner, then imagine what it is when you're risking $1,000 on a trade, and you overload yourself with decisions.
Absolutely, yeah, and that's a great point. And it's funny that you mentioned that. I always think of that when I go to a restaurant. I think, okay, let's see how smart they are. How smart are they going to be about this? And you open up the menu, and you're right. You see like 27 different dishes. Like this is crazy. And it probably also makes it difficult on the restaurant because they get to the point where they've got too much stock for a certain recipe, and now that's got to go on special. Whereas if you focus in on, 4 or 5 things that you do really well, it's so much better for everyone. The customers, the patrons of the restaurant, and the chefs in the business. So it makes a whole lot of sense, and that's a really great point, Darren. When I see those restaurants when they have too many, I just think, gosh, they're making a big mistake here. It's just not the right thing to do. And you see this, like you can see this in a lot of different areas where you offered like these 7 different phone plans or whatever. Really what they want to do is, if they're really savvy, is they'll boil it down. Well, do you want this or do you want this? And there's going to be 2 or maybe 3 options, and other than that, it doesn't make a whole lot of sense. So
yeah, and your trading should definitely be that way. You should distill it down, and like I was saying before, consider what really is significant, and just kind of boil it down into very simple entry choices, very simple management choices, and then ultimately simple choices when you exit. You need a little bit of flexibility in there, but you don't want to overload it. And if you want to use analysis, then again, distill it down. Consider 3 or 4 points that are most important, and just use them, and don't just keep adding more and more information, because it'll just confuse you. You'll make bad decisions, and you get in that spiral then of giving your money away. And
I have to, just as a last point here, I just have to share the M&M experiment. So they did this experiment with M&Ms, and this is kind of speaks to your idea here, Darren, about what this idea of having too many choices. They gave the people in the study, they say, okay, here, and they gave them a bowl of green M&Ms. Okay, give people a bowl of green M&Ms, and they'll eat a certain amount. Now, we know that if you've got a green M&M or a red M&M or a yellow one, they all taste the same, right? Do they taste any different to you, Darren?
No, they're all the same, Walter.
Yeah, of course. Of course they're all the same. Yeah, they're all the same. But if they give you a bowl of all the colors, the brown and the yellow and the green and the everything red, we eat 20 to 40% more. Because I don't know why. Do we feel like we're missing out? We feel like we've got to get more variety. And I think that's kind of the same thing that's going on here. When you have too many choices, you feel like you're missing out. You feel like you've got to get in on everything. And why do people eat 20 to 40% more M&Ms just because there's more colors out there? It's because that choice, there's too many there, and we feel like we need to really get in and everything. It's why people overeat when they go to a buffet. And trust me, buffets are really, really popular in the United States. I don't know how popular they are over there in England, Darren, but they're really popular in the United States.
They used to do this with Penguin biscuits. You got Penguin biscuits, which was just like a chocolate biscuit, and you got multi-packs of 6, and each biscuit was a different colour. And like the big joke was, what colour is yours? But they're essentially, they are exactly the same biscuits in the different wrappers. I wonder if that's what they were doing, just like making us eat more than we wanted by putting them all in different colour wrappers.
They probably knew exactly what they were doing, yeah.
Yeah.
All right, so last question, Darren. This is the 4th question of our 4 questions here. This is a support and resistance question. What is the relationship between the time frame you are looking at and the time frame you should be trading? What is the difference between the relationship of the time frame you're looking at and the time frame you should be trading?
I'm not 100% sure what the listener's getting at here.
Yeah, well, I don't know. My guess is what's happening here is this person is seeing too many support and resistance zones on the chart, and because there are too many support and resistance zones on the chart, you're trying to figure out which time frame should I be looking at to set my zones, and then drop down to a different time frame and trade. I don't know, but that's my guess here.
Yeah,
I think that's what's going on.
I think with this, with the time frame thing, again, you should distill it down and make it simple. When I used to trade support and resistance and multiple time frames, what I like to do was use a higher time frame for the overall trend, and then a lower time frame to enter, and then go back to the higher time frame for my targets. And this didn't give you any particular edge, but what it did was it kind of forced you to have a higher risk to reward trade. So I'd be using, say, daily or weekly levels, and then entering on the 60-minute or the 15-minute charts. And it just kind of forces you to say, okay, what I'm going to do is I'm going to trade a higher risk to reward strategy here. I don't think there was any particular edge between the different time frames from my point of view. I was just kind of using it as a tool to force myself to make better exit decisions. And certainly if you're looking at more than 2 time frames and support and resistance on all of them, and considering all of them in your decision process, I think you're just overcomplicating it and not really giving yourself any advantage.
Yeah, I mean, the easy solution here is you go up one. So if you're trading the 4-hour chart, you go up to the daily and you draw your support and resistance zones in there. If you're looking at the daily chart, you can draw your zones in on the weekly. That's the kind of thing. And you're not really, even if you're trading like the 60-minute chart, you can still draw your support and resistance zones on the chart with the weekly chart, and then wait for the 60-minute to give you a trade, and wait for the 60-minute to approach one of those levels. That's not that's not necessarily like a bad thing to do. I think the number one problem that people have when trading support resistance is they have too many, and the easiest way to get out of that is to simply shift to a higher time frame. Make sure that you've got all the ones that you think are really important, lock those in, and then wait. Go down to your time frame that you're going to trade and wait to get in there. So and it's kind of what you're saying, by doing that, if you're using support and resistance for exits as well, profit targets, then this is going to help you out, because they're going to be pretty far apart. They're not going to be really close by, and that's going to force you to wait for it to get to those further spots on the chart, and that's of course going to bump up your reward to risk ratio. So that's a really good point.
Yeah, I find quite often what traders would do was they'd trade like a specific system of time frames with support and resistance. They'd get into a trade, and then they'd have an emotion would come up whilst they were in that trade. Maybe they'd see a bar close against them or something, and then they'd go looking for a reason to get out of it and break their rules. So they'd sort of say, well, I'll have a look on the 4-hour chart. Oh, there's a support and resistance there. Okay, I'm right to have this feeling. I'll get out. And in effect, they're kind of curve fitting their analysis to comfort that bad emotional feeling they're having. So they're feeling fear. They'll go and find a technical reason to go along with that and then break their rules. And it's a bad habit to get into. And I think you have to kind of accept that, support and resistance are kind of like a guide for action. They're a point to, like you say, wait for price to get there. Then go through your process of entry or exit or management, and then let the trade do what it wants to do. And you can't really control that you can't always find a reason. So sometimes it's not a good idea to go looking for it. You kind of just need to go with the process and let the numbers play out.
Yep, that's great. That's great advice. I really appreciate that. That's great advice for everyone listening. That's there are a lot of things there that you said to unpack. And one of the things that kind of struck me, Darren, was it's when you said it's a reason to break your rules. And I think we probably could have an episode just on that, on reasons to break your rules, why, pros and cons, why or why not, why you should or shouldn't break your rules. I think that might be the topic for our next podcast, if you agree to that. What do you think about that?
Yeah, let's do that next week, Walter.
Sounds great. All right. Well, thanks so much for your time, Darren, and thanks to those of you listening. I wish you a wonderful and happy trading week, and we will see you next time. See you, Darren.
Cheers, Walter. Thank you.